Hello, everyone, and welcome to this Tresle webinar. My name is Joel Keeler. I'm the CEO of Tresle. I have a very exciting presentation for you guys today. Before I get started and introduce today's guests, I want to briefly go over what we'll be covering today. So there are many reasons why one can decide to sell a business, from retirement to pursuing a new business opportunity to kind of everything in between. For whatever your reason may be, however, it's important to understand the taxes payable on a sale, as it can likely be, one of the larger one-time expenses you'll ever have to pay. And that's not to scare anybody away, but that's just a reality and something that we want to plan for. So in this webinar, we're going to be discussing kind of what taxes are triggered in a business sale, what common mistakes are made by exiting business owners, and what are kind of some of the common strategies to lower tax liability, and a few other points. So today's format will begin with an interview with our guests, and then transition to a Q&A with questions that you guys submitted via social media, followed by a brief close. So with that, joining us today is Eric Pierre, CPA owner and principal at Pierre Accounting, a boutique full-service advisory firm and accounting firm with 3 offices nationwide. 1 in Texas and 2 in California. Eric's deep technical knowledge includes advanced tax strategies, planning and analysis, M&A, as well as forensic auditing. As a renowned tax expert, Eric has been featured and referenced in several top media outlets such as Forbes, CNBC, Bloomberg Tax, Yahoo Finance, Time Magazine, and CBS. So that's quite an impressive resume. It goes without saying that we're in good hands for today's topic. Thank you so much for joining.
Thank you for having me.
Yeah, so tell me, we were talking a little bit before we started the recording. Tell me a little bit about yourself, your background, and how long you've been involved in tax planning with business owners.
All right, so, thank you for having me on. A little bit about myself. I started Pierre Accounting as a part-time gig about 7 years ago when I was living in Houston. And then, I got tired of corporate America and the glass ceiling. So I started my own at 15. I moved to California, opened offices in San Diego and LA. And then we opened a 3rd office in about 18 in Austin. And so I personally reside in Austin now for tax purposes. And I'm still in California quite a bit, and I'm an avid sports fan, and I do have a Jordan sneaker collection. I think of about 40. I gotta go back and count. But I'm passionate about tax planning. So I've been doing it full time for 7. I've been a licensed CPA since 2006. So I've been in the accounting and tax industry for 18 years. And I've also traveled to about 26 countries for business as well. So I have a pretty unique background. I've seen a lot of things, and I still have a lot to learn. So,
nice. Okay, great. Yeah, thank you so much for that. So I guess the first question is, generally speaking, how is a business sale taxed differently than, income tax?
Well, so typically most business owners, they're selling their business now, there's different ways you can structure. You can structure as an asset sale. You could sell, a small portion of your business, or you could sell the whole thing. It depends on what's going on, whether you have investors or you're selling out, as you mentioned intro. But typically, those assets are held for more than a year, so that's subject to capital gains tax. Now, the one thing that a lot of people get tripped on is that a lot of small businesses don't necessarily do a good job of tracking their taxable basis, and the business which may not always be the same as your ownership stake or the valuation, because the capital gain or loss is dependent on the basis. And usually most small businesses are going to have a low basis or negative basis because of distributions taken. And so your tax bill may actually be higher than if it was your proceeds minus 0. So that's the one thing I would make sure. And a lot of business owners, particularly when you get into the larger transactions, don't pre-plan the sale. Because for instance, my firm does strategies where if you plan it out 6 months in advance and it's the gain is $5 million and up, we can actually structure it to where you're paying zero tax when you execute the transaction.
Okay, interesting. So, obviously there's a difference then, right, in operating a business and then ultimately when you go to sell. So maybe
Correct.
let's touch on, you touched on distributions and kind of lowering that I guess taxable income, so to speak.
Right.
Maybe let's touch on the differences in strategies and why it's so important to be understood and kind of plan for that.
Well, before you sell your business, a lot of people are good about going and getting valued, but you want to check your books and records on your basis, because your taxable basis is going to determine your gain or loss. So let's say I sell my firm today, and let's say somebody was crazy enough to give me $20 million. Okay. Before I would agree to do that, I would check my basis, because if I have a negative basis of, say, $1 million and I sell it for 20 million, my capital gain tax is actually $21 million. Well, that's not the gain, but the gain is actually 21 million. And then at 20%, that's about it's a little over $4 million.
Yeah.
So it's important to have good accounting. And, a lot of owners can get tripped up into taking excess distributions over the years, not keep an eye on it. And then over time, you get into a situation. I have a partner where he was working a transaction where they were selling a real estate building in the business. And because all the distributions, depreciation, they had such a negative basis, his tax bill would almost been as much as his proceeds. But because he contacted my partner ahead of time, I'm not doing this transaction. They're able to plan to where he'll be able to get the proceeds to pay zero tax. So that's why it's important. You want to pre-plan it, because depending on the kind of business or asset you're selling, because real estate, you can have negative basis. And it's not a bad thing why I say this, because you can get negative basis from your refinancing, accelerate depreciation, things like that. But without proper planning, you might get a nice surprise tax bill. Yeah. And if you don't have the proper accounting to track it, the IRS loves to take a look at sales. And the other thing too, depending on your state, for instance, you mentioned California. In California, you also have to pay state tax on that transaction. In California, they don't conform to the capital gains rate. So you have ordinary income. So depending on the state, you could be paying, 33, 35% taxes in places like California and New York State. Wow. So you were right. This can be a very big expense.
Yeah, totally. And you've sprinkled in the term basis, and maybe let's take it just a step back. And could you just define that for the audience a little bit, just so people...
Your basis it's basically the best. I don't want to get too technical, but it's basically your worth. So a good start for your basis is your owner's equity account. Your profit increases it, your cash contributions increases it, any owner distribution decreases it, et cetera, et cetera. So it's basically your stake. It's not the fair market value. It's not the valuation. It's your stake in the company. And it's complex, but it has a lot to do with your owner's equity balance on your balance sheet. That's one of the first places that you want to make sure you're keeping a good eye on, good records. And then if you're doing your tax returns, if you're in a partnership or an S corp, your K1s, you should be getting a basis statement every year. That statement is what's going to be used to determine your basis in the capital gain calculation.
Okay, awesome. So, one, and you kind of touched on this in your description. Thank you for that. So one kind of commonly overlooked topic, I would assume, is kind of how the sale type or the entity type can play a role in how tax is recognized. So, asset sale versus stock sale. Maybe you could just touch on a little bit about the differences and also entity type You
Yeah.
mentioned, you mentioned S corp. I'll let you kind of just touch on that.
So if you have an S corp, it gets difficult tracking the basis of if you own real estate inside it, but you can do a stock sale in an S or C corp, and then partnership. You're just going to be selling your partnership stake, and then again, an asset sale versus a stock sale. It's also depend on the type of transaction. I don't want to get into it. That's part of the plan. So, depending on the size of transaction you get with your attorney, your accountant, and the counterparty's attorney accountant, and figure out the best way, because depending on how it's classified, you can also spread out the proceeds, but the Biden law may be changing that shortly. So
yeah,
before you even think about selling, you should get with a specialist, because now I'm not knocking CPAs. Not all CPAs have that knowledge. So if your CPA doesn't have knowledge, you don't necessarily fire them. You just need to go partner with somebody that specializes in these kind of transactions. We have an in-house tax attorney that specializes in this is what we would call a liquidity event.
Yeah.
And then, you get a small consultation, but through that, we, help you break down what your options are, what your exposure is. And then if you plan it right, you can structure it to where you could pay, zero tax, or cut your tax bill in half. Because some sales, some installment sales, the initial part of the proceeds are capital gain. But if you do installment, then the rest of it is going to be ordinary income. So that's why the planning is very important, because the tax code is very complex. But if you have a C corp, for instance, and you sell and you have founder shares, you can get $10 million tax exempt. So that's where you can't get that in an S corp, but you can have that in the in a C corp. So that's why it's important to consult with the accountant before you do the transaction, because you may end up paying tax if you own a C corp, and you can get the first 10 million tax free, and you didn't review that, and you unnecessarily pay tax.
Yeah, totally. And also location probably, plays a large part. Is there maybe a specific example of, a client that you can think of, or, a scenario that you could think of where it made a large difference?
Yeah, I could give you an example. So if I were to sell my business in California, using an example, $21 million gain, federally in Texas, I don't have to pay a state income tax on top of that. In California, I have to pay 13.9% ordinary income tax on top of that. So it gets expensive very quickly depending on your state.
Okay. Yeah, no, amazing. Yeah, thank you for that. So, we've kind of covered the basics. So maybe let's transition to actual structure. So, can you start by maybe defining what is purchase price allocation, and then touch on how allocation can impact, how a sale is taxed? So, and we don't have to get into the specifics of, percentages and such, but like the fact of goodwill versus equipment versus other elements. So maybe if you could touch on that and define what that is.
Well, so first of all, goodwill is simply is an intangible asset. Now that's going to depend on the business. So for instance, McDonald's, they have goodwill because the Golden Arches. So they have an expensive intangible asset. Certain businesses like your business, the intangible asset may be your reputation or your client list. So that's going to vary, and that's negotiated ahead of time. And usually you bring in some on bigger transactions. There's going to be some sort of M&A specialists involved, and when you're selling equipment or real estate as part of an asset sale, those things are going to be valued. So I can't necessarily put it in one box. Unfortunately, It's one of those, it depends, because my business, I don't have a lot of equipment. So if I were to sell, it's gonna be based on my client list.
Yeah.
And the ability to, the recurring revenue. So I'll say this, for a lot of service-based businesses, your valuation is going to depend on the amount of recurring revenue and your market share.
Yeah.
That service business like ours. So if I have a large clientele and we're able to, and there's consistent revenue 5-10 years, you're going to get much higher price than say somebody that's consultant. We're consultants, they come in and do one-time deal and they don't have a consistent client list. Well, their business may not sell for as much.
Yeah. Yeah. No, that totally. And how it's taxed, is that different as well?
It's going to depend on it. Again, if you have the business, depending on the asset or the type of sale, usually, again, if you've had the asset more than a year, it's capital gain.
Yeah.
But if I'm talking to you through this iMac. So let's say some accountant is so desperate for this new 24-inch iMac a few months ago when it was in short supply. I bought it for $2,500. Some accounting firm say, I gotta have it because I got Mark Cuban coming through, and he told me that if he sees me with something less than iMac, I'm not getting the deal. I'm going to pay you $15,000. Well, of course I do the deal. That's the ordinary income. I've had the asset for less than a year.
Yeah.
So,
okay.
You can sell assets without selling your business. There are companies that sell equipment to other companies all the time.
Yeah. So no, that makes sense. That makes sense. So what would you say are some of the most common pitfalls that you see with business owners, that they make as it relates to tax planning for a sale?
Bad accounting. A few years ago, I was in contact with a salon out in Poway, California. We went to the place. They needed accounting cleanup. They went cheap and wouldn't pay me to do the work, and they wanted to hire someone from the community. And so the proposed sales price based on their market and clientele location was about $950,000. But because the accounting was so bad, she barely got $500,000, lost 50% of value because of bad accounting.
And what do you mean by bad accounting?
They couldn't verify the income. This was a little unique because the salon also had an ATM right in the middle of it. And she denied that she owned it. Of course, that doesn't make sense.
So a lot of cash transactions.
It was a lot of cash transactions. And so the revenue numbers were real low comparison to the traffic. And so the buyer had a good accounting staff, and they're very savvy. And they said, if you can't prove these numbers, we're not paying you what it's worth. You have to take half. So they barely got half. But had they done proper accounting, she would have got $1 million, but had to settle for, $480,000, and all because she wanted to nickel and dime me over a $3,000 price difference. But,
I guess lesson learned.
Yeah. So don't go cheap on your accounting. You don't necessarily have to pay the top dollar, but there are a lot of, if you're making $500,000 in revenue or more, and you're spending only $100 a month your accounting, you're going to get screwed on a sale. Yeah. Because people that are spending real money, they have really good, sophisticated accountants, and they know how to. Because I've found mistakes before that's impacted valuations. I'm also a forensic accountant, so I can tell right away. Yeah. Especially when you do due diligence and you go to facilities like, it doesn't line up. So invest a little bit in your accounting because it'll pay off when you do the sale.
Yeah, I'm sure that's one of the many, graveyard stories, if you will. So obviously, lesson learned is that having a solid understanding of these things and involving the right help can save business owners, in the long run, save them thousands, in the scenario, tens, hundreds of thousands even. So maybe on the flip side, can you think of a scenario where somebody actually did recognize the problem and brought in the right help or did the right thing, and how that ultimately was kind of like the opposite story of the one that you just gave?
We helped a dry cleaner sell their business, and because we did the accounting, they got all their money. So we did a cleanup, and the revenues jived to the traffic, And, the buyer worked with a large accounting firm, and they said that whoever you hired is sharp as tack. They know their stuff, and they were able to get, a few $100,000. I think it was like 300,000 or 400,000. And,
Wow.
they didn't go cheap on that because they needed the money to get out and clean themselves up and start over in life. And so we will help that guy out.
Nice. Yeah, no, that's awesome. So, it's switching gears just a little bit. So are there in a transaction, the way that a deal actually, maybe not structured, but the actual terms of the deal, is there a way that this can lower one's tax liability? So for example, versus all cash upfront, let's say for a purchase of $1 million business, right? Versus getting a check for $1 million. Are there any other structures that or terms that can lower tax liability?
Well, every case is going to be different, but if you do the installment, you could. There's a guy I know in another state. He did a multi-year earnout. So the way it's structured, and they had some very high-end accountants. So he's gonna get something like, I'm just gonna change the numbers, because I don't want to say the real numbers. So these numbers are saying there's a story, I'm just changing it. He's gonna get $20 million in year one. That's gonna be capital gain. And then the rest of it, it's gonna be ordinary income, but those amounts are lower. So he's getting 60%, 70% up front, but he's only have to pay 20% tax. Now his tax situation is unique because he had a high salary. He's got other sources of income. So we're going to be doing some tax plan for him this year, hopefully. But in that situation, overall, he's going to lower his tax, because then the next 2 years, depending on he's staying on to help the transition, the other payouts are ordinary income, but we can lower his exposure from, 50% with the state down to 20% plus, another, he lives in multiple states. So if he's in Arizona, it might be 22 and a half. Okay. So there's a scenario where he's going to pay, his tax rate is going to stay the same, even though 1 year is capital gain and the other years it's ordinary income. So, so the ordinary income years we would do what's called deduction hunting. You could do it at the end of the year. Had he contacted us, he actually read my CNBC article. He wished he had contacted me 6 months before the sale. We could have done it was a very large transaction. The whole thing would have been zero. And then he could have accessed 30% of the proceeds in a few years without paying tax.
Wow.
Grown an investment account. Yeah.
Yeah. So you mentioned earnouts, and a lot of the time, well, by kind of their definition, earnouts are, kind of linked to the company's future performance, but a lot of transactions also take seller notes. So essentially like a loan to the buyer at a certain
you could do
coupon,
like
right?
Is
that something that people can also look at?
You can do that, but every situation is different. So I can't tell. You can do a loan where the income is interest. You can do it through an ESOP. There's ways you could do it through Keyman policies where you could do buy sell. This is where you would get a consultation with me and my tax attorney, because we have to know, because part of it's going to depend on, you could have two people with the same money, but one person is going to be very charitable. They could be like Warren Buffett, say, look, I'm going to give away 89%. My heirs will be okay, but they're not getting $1 billion. That's his mentality.
Yeah.
Other people's like, look, I need this money because I want to be like Elon Musk, take 20 million, invest in another business and grow it to $1 billion like he did when he sold PayPal. So everybody's situation is different. There's no one size fit all.
Sure.
So it's going to depend on what your short and long-term goals are, dictate. And also depends on dealing with the other party. Hopefully you have a counterparty that's willing to be amendable to your terms. Yeah,
totally. And for small business owners as well, a lot of them own their real estate that, let's say it's a manufacturing plant or something like that. I guess you could also, selling the real estate as well is kind of treated like two separate transactions. You could, in terms of just kind of looking at the big picture, and I totally understand that each situation is different, but probably deciding to rent the building versus
the real
selling.
estate. If normally in a situation where the manufacturer facility owns it, hopefully it's in a separate LLC, so you can take advantage of accelerated depreciation.
Yeah.
One of the things you can do is if you're doing accelerated depreciation, which is basically cost segregation, some people have never heard of it, but when it's time to sell, you could do a look back study and still get tax breaks before you sell it. What they call a look back. So with real estate to me is the best place to park your money. And there's so many tax breaks. We did a cost seg study for a client of ours. They had a house in Newport Beach, bought another, they used the proceeds from the primary sale, bought a complex in Orange County. And then with the CARES Act net operating loss, we were able to get them a refund of close to $200,000 because of the net operating loss from the cost seg.
Oh, wow.
Which I have to call the IRS about because they processed the return wrong, but they're going to be owed a couple $100,000 when I'm done talking to them.
Wow.
Yeah.
You kind of touched on this earlier when you're talking about, I guess, the planning elements. I want to circle back. Does time of year play a role into kind of when owners should be looking at this, and just in general? Like, are there opportunities that
time of year? I would say it depends on what your income is, but you just want to give yourself enough timing. I think timing, not necessarily time of year, timing. Now, there are some situations, depending on your income, that time of year can import, because if you get an offer to sell on December 31, you may want to wait a few days and then you get a whole nother year to pay that tax bill.
Yeah.
So,
no, that makes sense.
So
very extreme circumstances or extreme scenarios.
Yeah, I mean, but again, most people usually are just, they get an incredible offer, just like, all right, let's go. And I think about, well, hold on, let me take a step, and let me make sure that I'm doing everything I can. Especially if you start making $5 million and more, you can pay zero tax through the tax code. It's a strategy I'm not going to discuss for free out here, but
of course,
it's my tax attorney is doing it for 3 or 4 clients this year, and it's a lot, and it's a game changer. Yeah,
no question. So, we talked about deal structuring and so on, but let's assume a good chunk of the post-close proceeds, seller receives a sum of money. Are there certain things that they can do to lower their liability? Maybe charitable contributions, you kind of touch on that. New business purchases, kind of rolling it into another.
So real estate.
Yeah. Could you touch on that?
If you're not able to do 1031, there's also strategies. Some of these sales maybe order income. So, we help our clients do things like conservation easement, fee simple, where you can reduce your AGI 30 to 50%. There's also other strategies out there. If you have a lot of money, or if you can do a multiple-year earn-out, you can invest in oil and gas. We're affiliated with an oil and gas company that has a great rate of return, and you get your investment, you get to deduct the intangible drilling costs. Most of it's in year 2. So if it's split, and let's say most of your proceeds are year 2, then you can time that deduction on an oil well property in year, 85% in year 2, you get 15% in year 1.
Okay.
So I'm not saying to be a shill, but that's just an example where, depending on the earn out and what you have going on, there's some tax strategies you could do for multiple years, where earn out in year 2 may be bigger than year 1. So you can get the deduction then, and then make your money oil later, and your income after your earn out may not be as high. Because as you said, this is going to be one of your biggest transactions, selling a business after selling a home in your life.
Yeah, totally. You touched on 1031 briefly, and I think this is important. Maybe you could describe this for us as well as kind of like the timeline that sellers have.
So if you're going to do 1031, it has to be on real property. It cannot be your personal. You have to identify the property. You have, I think they've relaxed the rules, but basically you can never touch the money. Once you've identified a property you want to exchange, you need to contact an accommodator immediately. Because it was like 45 days identified, closed 180. That was the old rules. I think that it was a little longer during the pandemic, but you cannot touch the money. You can never, if you touch $1 of it, the whole thing is blown.
Okay. So important for folks if that's in their part of, even conceptually part of their plan to know this before they're touching it. Okay. Yeah. Awesome. So, I think that concludes kind of most of the interview portion of the discussion. Now I'll kind of transition into questions that we received via social media. So,
okay.
And there might be some overlap here, but we'll try our best. I'm reading these for the first time. So, at Algum asks, what do they, meaning you, think people should know about tax when it relates to selling their business? So, I guess maybe we've covered a lot of that. Maybe just your number one tip.
You should talk to your accountant.
Okay. And planning. We'll sound like
talk to your accountant and plan before you I would say your taxes depend on how good planning you do. You should do the planning before you sign the letter of intent. Once you sign that letter of intent, it is hard to undo that, because you could, if you sign your letter of intent before you plan a transaction accordingly, you may end up overpaying your tax. That'd be the best thing I would tell somebody to answer that particular question.
Okay. So I guess Sherry, at Sherry Q7 asks, are there situations where mergers or reorganizations are tax-free, and how would that look like? What would that look like? Excuse me.
Well, mergers are usually someone really acquiring somebody else. Tax-free, it depends on the size. So if the proceeds, if the gain is 5 million or more, we can structure tax-free. If the basis is equal to the proceeds, it's a tax-free transaction. I guess the other scenario would be if you inherit a business to sell, there could be a potential step-up basis. We'll see a step-up basis is still around with the tax bill, but if you happen to get a step-up in basis, such as a property, that's a possibility. A commercial property, transfer individual to a trust. You get the trust, the estate gets the step up. That could be a tax-free transaction.
Okay. Thank you. At B Rosenblum 45 asks, can you explain the double taxation of corporations?
All right. So double taxation is in the C corporation. So current law, a C corp pays a flat tax of 20%. Now, if you get your compensation through a C corp, then your wages are going to be taxed at the individual rates on your W-2. So if you own a C corp and you get paid, that's what the double tax is. Otherwise, most businesses are pass-throughs, and there's one tax and it's passed to your individual. So I usually don't recommend C corps unless you're going to have a lot of investors or doing some sort of capital raise, or the company does a lot of reinvestment. Okay.
Awesome. At Biz, and this is the last one, at Biz Before Sun asks, how does reinvesting in opportunity zones work from a tax perspective? And how long after a sale does one have to do this?
Okay, well, so I think we did a podcast on it. This is the last year where you can roll a capital gain into the opportunity zone. And if you stay in it for 7 years, you basically get a 10% discount off your capital gain. If you're in it for 10, you get a 15%. So they want you to stay in it for 10 years, but you have to stay at least 7 if you defer capital gain before the end of this year to get the 10%, and then 15% in 10 years. Now, but then when you sell your investment in the opportunity zone, all that gain is tax free.
Okay.
But for deferring gain, like from what we discussed at our podcast, CPA Huddle, you have until the end of this year.
Okay, and that's going to be changing?
Yeah, it's going to expire. And then going forward, you can invest new money to Ozone, but to get it tax-free, you have to stay in it for 10 years. But if you want to defer 15% of your capital gain to roll into the opportunity zone, you have until the end of this calendar year.
Got it. Okay. Awesome. Well, I think that concludes the social media Q&A, and thank you to everybody that submitted a question. Your participation is always appreciated. Eric, I think we can agree that selling a successful business can be a happy event, but it's important for people to not let that kind of surprise tax bite down and kind of ruin the moment. So, as such, a tax professional should be engaged to help consult and manage kind of the details in any particular. So I like to end, I guess, by seeing if there's any questions or messages you'd like to leave, I guess questions that I neglected to ask and messages that you'd like to leave with the audience.
I would say just, make sure you do your planning before you sign a letter of intent. Once you sign a letter of intent, it's hard to undo. It gets very difficult. I mean, you can back out, but usually once a buyer signs a letter of intent, they want that business or asset right away. So plan, because without planning, you are planning to fail.
Yeah, there you go.
And you're going to end up overpaying. And I'd hate for somebody watch and not plan and then do a sale where they have a gain of $12 million and they're paying 35% combined federal and state, when with proper plan, they could have paid zero and been patient.
Yeah, no, absolutely. Yeah. Definitely worth the time and I guess thought process beforehand. So last question is, where can people find you online?
Online, our website is pierreaccounting.com.
Okay. And I'll link that in the show notes below.
Thank you. Well. My personal Twitter page is Your Fave CPA. Instagram, you can find us at Pierre Accounting, and on Facebook, you can find us at Pierre Accounting. And then, if you want to connect with me on LinkedIn, you can just type Eric Pierre CPA, and you'll find this face, and you'll find me there.
Awesome. Well, this has been a ton of fun, and I really appreciate you carving out the time to provide that insight on today's topic. Although there's lots of nuances, I think that gives a good groundwork and foundation of what people can definitely look to expect for. So, and lastly, thank you for everybody tuning in. If you're looking for more information around buying and selling private companies, check out our tools, resources, and blog at Tresle.com. We will also link that below, and further suggestions for future guests or topics, drop us a line at hello@Tresle.com. Thank you so much, everybody, and take care.
Take care. Thank you.